Darrell Riley, before we look ahead to the second half of 2015, how would you sum up the first half of 2015 so far with regard to the stock market?
Investors are telling us it's a real tough market to put new money to work. Equity valuations are on the expensive side of normal, and bond yields are so low that there's not much margin of safety in the event that yields rise.
All right, that said, give me your outlook for the rest of 2015.
Right, so on 2015 for U.S. equities, again, valuations are relatively rich. So let's look at what we can get out of U.S. equities. 2.5% dividend yield, 1.5% buyback yield, 6% earnings growth. That's really not so bad when you're comparing that to a cash returns of 0.
Well, that's not so bad, but how does it compare to Europe, for example? A lot of people in the first half said they like Europe better than the U.S. What about you?
Right, so let's look. We've got slowing momentum in the U.S., and we've got cyclical recovery in Europe and Japan. We've got QE in Europe, QE in Japan, and we have fading in the U.S., tapering in the U.S. You know, that combination is favoring Europe and Japanese equities over the U.S. And we see valuations that are modestly cheaper in Europe and Japan.
And one of the big worries for emerging markets is that you have rate hikes here, it hits emerging markets disproportionately. At least traditionally that's been the case. So what's your view on emerging markets with that in mind?
So emerging markets is the most contrarian bet in the equity world today. A lot of those fears that you talked about are priced in, honestly. There's probably some wiggle room when we see rates rise, but for the most part the market is expecting a very well telegraphed rate rise. But for us as active managers, we don't look at emerging markets as a unitary asset class because there's so much dispersion within that asset class by country and by sector. And so for us, we like emerging markets. We're overweight emerging markets in the asset allocation portfolios because they're cheap and we can own those companies that are more exposed to cyclical growth and have cheaper valuations and are more resilient to a strengthening dollar.
I want to get to something that's fairly close to equity, and that's high yield at this juncture. A lot of people say that high yield is priced too high, that there's too much risk in high yield right now. What's your view?
Well, if you look at spreads relative to history, they are lower than history. So some people might conclude that they're expensive. However, relative to 0 on short-term bonds, the yield pickup is relatively good, and we like the shorter duration profile. We're comfortable with the default rates today, and so we're overweight high yield in our asset allocation portfolios.
If there's something that could throw off your forecasts, what would it be? Is there something that you're wary of out there?
The number one worry, honestly, is a deceleration in global growth. That would screw up everything, right? Because when we see a deceleration in global growth, that takes down economic growth across the world, hits earnings growth, hits valuations, and that would change the game completely.
Which leads us to China, because people are seeing China slow down. So is China what you're watching? Is that really what worries you in terms of if they slow down, everyone's going to slow down?
Well, I mean, China certainly is slowing, but we know that. I think our expectations are for modest growth, and I think that's reflected in stock prices today. The government is doing what they can to reaccelerate that growth, and we're seeing that come through. So I think the market's pricing a relatively disastrous scenario for China. We don't see that. We see opportunities within China. We see opportunities in India and other emerging markets.
All right. Thanks a lot, Darrell.
Okay. Thank you.